Good afternoon and welcome to Meridian Energy's interim result announcement for the 6 months to 31 December 2018. I'm Neil Barclay, Chief Executive, and I have with me Paul Chambers, our CFO. I'll talk to some of the highlights and environmental factors that we're seeing, and then I'll hand over to Paul to talk to some of the business performance in a bit more detail. We posted a good result for the period. EBITDAF was up 389 million, which is a record first half for us, and 18% up on the prior year. In New Zealand, healthy starting hydro storage and good winter inflows into our catchments allowed us to lift generation by 10% and sell that additional load into high wholesale prices. In March, we purchased the Green State hydro assets, which contributed to our growth in Australia, and our UK customer sales were also up on the corresponding period. The improved cash flows have allowed us to increase the interim dividend by 6% over the last year, and we've also declared an interim special dividend of 2.44 cents per share under the company's capital management program. Meridian has now distributed 500 million of a targeted at $875 million by February 2022. We continue to buck the trend of the major retailers in New Zealand, and we've grown our customer numbers by 5% across the Meridian and Power Shop brands. So while favourable hydro inflows and market factors have certainly influenced our financial performance, we can see our growth strategies starting to deliver. Significant volatility in wholesale prices has been a feature of in the three countries we operate in, and I'll just talk to some of the dynamics around that volatility. Wholesale spot prices in New Zealand between October and December were very high. They averaged $206 per megawatt hour at Otahuhu. These high prices were heavily influenced by the interruptions and uncertainty around gas supply and distribution. National storage continues to decline slowly, and whilst this is not outside the realms of normal for this time of year, when combined with these gas constraints, plus some scheduled maintenance outages for some thermal plant and some growth in electricity demand, it's no surprise to see the market signalling fuel scarcity through higher prices. We've also seen a lift in forward prices. Long-dated futures prices are up between 15 and 20% from 6 months ago. And again, this is the market working, I believe, and as a result, some new generation options are being positioned for build. Headline demand is reported as flat, but when we strip out the variable irrigation component, we believe we're seeing modest yet consistent growth. We note that residential demand increased in 2018, and that despite that being the second equal warmest year on record. The graph shows the change in demand between calendar years 2018 and 2017. We expect the demand growth of up to 1% to continue in the short term, and this growth strengthening over the longer term in response to our country's zero carbon aspirations. Tiwai's fourth potline is a notable component of the demand growth story. This 50 megawatts of contracted baseload consumption, now close to full operation, has added 1% to national demand and 10% increase to the smelter's capacity. Looking at this from Tiwai's perspective, I think that additional production has come into the aluminium market just as LME prices have come off the high points seen in the middle of 2018. But if you play a long game, and I believe the smelter owners do, then it does make sense to increase production. If a global price for carbon anywhere near the real cost starts to emerge, then the relative competitiveness of this facility, having one of the lowest carbon footprints in the world, should only improve. Wholesale market volatility in Australia remains a feature. Falling LGC prices have been working against us. Developer contracting and retailer arbitraging of surrender obligations between 2019 and future years has seen downward pressure on green pricing over the period. Black prices have been influenced by ongoing concerns with summer system reliability. The extreme high price events on the 24th and 25th of January this year, where $14,000 prices existed for a number of hours on both days, were a good example of what can and does happen in the Australian environment. MEA's relative conservative hedging strategy and our drive to diversify our generation base meant that our generation volumes exceeded our customer load during those high price events. The next few slides provide an update on the regulatory reforms underway in New Zealand, Australia and the UK. As you know, there's been a lot of talk about the goal of achieving 100% renewable electricity by 2035 in New Zealand. The reality is that goal is unlikely to be economically feasible. We need forms of deep storage to manage supply when hydro inflows are particularly low in this country, and the consensus view is that gas will remain cost-effective as a hydro-firming fuel for the foreseeable future. But I think the debate around that particular target is moot. It's inevitable that renewables as a percentage of total electricity generation will increase as much as 95% within the 2035 sort of timeframe. And the remaining emissions from the electricity sector will be very low, and I think that's acceptable given that renewable electricity is the solution for removing the bulk of New Zealand's non-agricultural emissions. With significant renewables growth on the horizon, Meridian will ensure our portfolio of new generation projects gives us the option to maintain our generation market share over the long term. We presently have a development pipeline that we believe is likely to meet our share of new generation over the next 8 or so years. Now, given the lead time for a new development has historically been around 10 years, we've got quite a bit more work to do in that space. The Electricity Pricing Review, breaking news, published their options paper this morning. Now, this may be famous last words because we're still digesting the report and what the panel are framing as their preferences, but on first read, my impression is it looks like a well-considered set of recommendations. We note the panel favours prohibiting prompt payment discounts. Now, Meridian has, of course, already moved to replace PPDs by offering lower upfront rates. We did this because PPDs are fundamentally unfair and disproportionately hurt customers who are struggling the most. So we're very pleased that the panel agrees with us on that point. We're also pleased that the panel does not favour retail price caps and does not favour prohibiting vertically integrated companies. We've always believed that neither of those steps would ultimately provide any benefit to consumers. I think if you're looking at parts of our sector where savings could be made for end consumers, then transmission and distribution pricing reform offer the greatest opportunities. We note the panel are recommending the development of government policy statements for both transmission and distribution pricing. Now, this may seem like a good idea, but I'd hate to see the initiatives that the Electricity Authority is currently pursuing be further delayed. Now, regardless of possible future changes, under the current transmission pricing regime, we've become more confident that Meridian's HVD charges will reduce to around 70% of current levels from 2020. And this reduction occurs as lower regulated WACC is phased in and historic recovery of underpayments is phased out. In Australia, the Victorian government is marching towards retail price regulation in the form of a default offer price. We understand this will include a cost of supply, a reasonable margin, and customer acquisition and retention costs. So on the face of it, it looks kind of okay, but in principle, however, we are not in favour of retail price controls. Over time, they can curb innovation and harm service levels and competition. Australia has yet to adopt a clean energy target, and energy markets are politicised and very volatile. We remain alert to the risks, but on balance, we believe this level of volatility creates opportunity for our business in that environment. The UK has introduced price regulation, putting a ceiling on default tariffs. The level of this price ceiling is reviewed twice yearly by the regulator, and they have recently announced the ceiling will rise just 4 months after its initial introduction. Now, rising wholesale costs appear to be behind this. Our franchise agreement with npower does not expose us directly to market risk. However, we are exposed to npower's success in growing the PowerShop brand as our fee in the licence agreement has a variable component based on customer numbers. Heightened regulation is one of the reasons behind the abandonment of the proposed merger between npower and SSE, and Paul will cover that in a bit more detail shortly. In terms of the business update, I think, we've seen very good growth in overall customer numbers. We're up 14,000 in New Zealand on the prior period. PowerShop has been enjoying stellar growth, and they ticked off 70,000 customers as of a couple of weeks ago. Irrigation volumes were well off last year. However, this worked in our favour as we had scope to sell more volume through wholesale channels at good prices. We migrated the first Meridian customers across to the Flux platform during the period. Now, I must admit, these customers all work for me, but it is a logical place to start and test our service. We aim to migrate a significant number of external customers onto the platform before the end of the financial year. And lastly, as I mentioned earlier, in October, Meridian stopped the practice of offering prompt payment discounts and replaced them with simplified, fairer tariffs that lock in savings for customers. I'm very pleased that the EPR panel have supported us on this move, but I'm sure you've heard differing views on Meridian's stance and how some customers love their PPDs. I'll just say that Meridian's customer base has continued to grow since we first announced our change back in September. It certainly has taken some effort, but I'm confident our customers now understand that our pricing is more transparent and fairer for all. So with that, I'll hand over to Paul.
Thanks, Neil. You've heard from Neil about the almost 20% shift in the ASX forward curve and the more marked lift in spot prices across the half, as we saw the impact of gas supply issues and thermal outages. So with good opening storage and decent inflows hitting us in early November, we were able to generate slightly above historical average volumes into these prices. On top of this, the 699 gigawatt hours of back-to-back cover in relation to the smelter and a further 352 gigawatt hours of other buy-side hedges increased our effective generation length, which supported both strong volumes of well-priced sell hedges, which were up 467 gigawatt hours on the prior period and at an average price of $14 better than last year. Plus, we were still left with an effective long wholesale position, with the buy-side hedge gains and FTR cover neutralising completely the impact of inter-island price differentials. That general theme has continued into the start of the year, and January was very strong, but we all know how short-lived this can be. Moving on to Australia, the completion of PPA agreements towards the end of last financial year has enabled us to get ourselves back into a growth mindset. We completed work on a number of new products and routes to market during the half and saw a small lift in electricity customer numbers, and our gas customer growth has actually exceeded our plans. This has continued into January with a further net gain of 1,600 electricity customers and 1,800 gas customers. On the generation and wholesale front, however, this half felt the impact of both the positive impact of extra volumes from the Green State assets, although drought conditions have curtailed hydro earnings, particularly of LGCs. On the other side, the price of LGCs has fallen significantly against last year, partially offsetting both the hydro earnings gains and the positive impact of retail progress, and I'll cover the various elements with some numbers later in the presentation. Moving on to progress outside Australasia, as Neil mentioned, customer growth has been tricky given the number of competitors making offers during the period at a gross margin loss. We've still seen our customer N-Power grow by 30,000 across the period through rapid response to short-term lulls between the crazy pricing behaviour. And whilst we've seen some fairly sizable players collapse under the weight of sub-zero margin offers made by them, UK politicians still see energy as a vote winner amongst the disaster area of Brexit, with price caps the result. And whilst they're not likely to sit below Powershop's current pricing, they were the final straw for the proposed N-Power SSE merger. This does introduce some uncertainty for our UK position, but we're working hard on providing a set of customer solutions that will support a continuation of our UK contract beyond 2023. Moving on to some further detail on the financials, I'll start with dividends. Strong cash flows and a consistent stay-in-business CapEx level continue to support a steady increase in our ordinary dividend, up 6%. Imputation is in line with prior period, although the position on our imputation credit account does mean that this will drift towards our long-term average around 80% over the next couple of years. And of course, the capital management program continues, and with our announcement in August 18, this now runs through to 2022. So moving on to how everything you've heard about translates through to earnings. Energy margin from our retail segment was down $12 million on last year, and this is almost all attributable to lower irrigation volumes, slightly offset by gains in residential and SMB sales. Overall, prices held up, and we are now seeing our C&I prices firm on new contracts as the ASX forward curve lifts and those prices follow. As I explained on the NZ generation slide, stronger physical generation supported a big increase in sell-side hedges at good pricing and left us long to a very well-priced market. Overall, we saw a lift of $70 million in energy margin for the NZ wholesale segment. Australia benefited from the Green State purchase, with energy margin up $9 million on the first half of last year. I'll cover this in a bit more detail on the next slide. And this is all offset by cost growth of $8 million, which included both overseas expansion and the impact of a particularly OPEX-heavy set of refurbishment projects in New Zealand. Our overall EBITDAF at $389 million is, as Neil mentioned, the highest on record, up $60 million on last year. and it's no surprise that this translated straight through to a record first half operating cash flow of 262 million, up 100 million on the first half of last year, although this does include reversal of the timing differences that weighed on the FY18 full-year cash flow. It's a bit more detail on Australia. There are a number of moving parts in the Australian result. So firstly, we saw the addition of $12 million of energy margin from the Green State hydro assets. And although positive, this was impacted by drought conditions, particularly in respect of LGC earnings on one of the 3 hydro stations. Other positive impacts, smaller but still positive, included some firming in average retail price and, of course, the earnings from Victorian gas sales. These were offset by a very sharp reduction in LGC prices, which reduced earnings by $5 million. Although LGC exposure was hedged through forward sales, their accounting treatment means that those benefits will not be felt in EBITDA until January 19, when the forward sales settle. We expect over $10 million of positive impact compared to last year, which unfortunately will only go to offset lower LGC prices, which we will recognise for generation in the second half of FY19. On the cost front, the Green State assets added around $2 million to the OPEX base. The remaining increase in cost of $4 million included investment in marketing and promotion associated with gas launch and the renewed drive for growth, along with increased metering charges, which were passed through to customers, and the cost of establishing a gas trading position. So before I go on to the items of more interest to accountants, I'll just summarise the various cost influences that I've mostly covered elsewhere. As I described earlier, the main influences on costs have been a couple of OPEX-heavy asset refurbishment projects, specifically on the Ohau chain and Te Apiti, the inclusion of the Green State assets and growth investment in Australia. Encouragingly, everything else was held flat, and we're working hard to realise the benefits of the move to the Flux platform in retail over the next couple of years. Stay-in-business CapEx, including the cost of the Flux platform move, is still expected to be within our long-term $65 million forecast across the whole year. I won't dwell long on this slide. Most of the action below EBITDA has been in non-cash fair value items, with big gains on forward electricity purchases in New Zealand, where we were net buy, and forward sales of LGCs in Australia, where we were in a net sell position. And those were offset by the impact of decreases in global forward interest rate curves. Everything else there, I think, is much as you'd expect. And my last slide is really one strictly for the bankers in the room, though it's worth noting that we've just closed out a $300 million US private placement last week. It's $300 million US, refinancing the early end of the maturity curve you see on the top chart, and funding the ongoing special dividend. And this was achieved at some pretty astonishingly competitive prices across the 10, 12 and 15-year maturities. And on that super exciting note, I'll hand back to Neil.
Thanks, Paul. Just a few concluding comments from me. I think our operating numbers have obviously been very strong. January and February continue in the same vein. But supply is tightening further, and with planned gas network outages over the coming 2 months, it's likely wholesale price volatility isn't going away anytime soon. There is political and regulatory change on the horizon here in New Zealand and in Australia. In the New Zealand context, there are significant inefficiencies in transmission and distribution pricing that must be addressed. The reforms necessary are hard to drive through, but the current and future costs to consumers, if we can't deliver these reforms, are great. Across the ditch, bipartisan political support for some form of green energy target must emerge for Australia to move forward. And to finish on a positive note, New Zealand's largely renewable electricity sector can be leveraged to remove a large portion of our country's CO2 emissions. So it's a great time to be leading a business in this sector. Thank you. Now we can move to questions, and I think we'll take questions from the floor here in Wellington first, and then move to the phones. You just introduce yourself, Andrew.
Sure. So Andrew Harvey-Green from Forsyth Bar. I have a couple of questions from me. First of all, I guess just on the EPR, and you gave your initial thoughts on that and generally saw it as reasonably positive. Is there anything in there that causes you some concern?
Look, we still need to get under the details and understand exactly where they're coming from. There's one suggestion there of a form of forced migration of customers after a number of years with the same retailer. I don't think that's where the panel are going with that. It would probably some sort of opt-in mechanism. I think, when you look at the New Zealand market, we've got lots of choice, and it wouldn't be the Kiwi thing to take choice away from people. And probably the other thing, there's a lot of ideas there, right? And a lot of those ideas involve committees or industry groups being set up. So I suspect when the final list of recommendations is agreed by the government, there'll be some level of prioritisation that goes into that.
Next question, I guess, was just around the need for new generation, which you hinted at in the presentation. In the past, you've talked about the Hawke's Bay wind farm. What's your sort of current thinking around that and potential timing?
Yeah, we think we've got the strongest next generation option available to the country. And that particular wind farm does need some consent adjustments. We're currently working through a process to get the tip height consented, lifted by something close to 15 metres, I think it is. That's an involved process. You've got to bring along communities plus the council process and so forth. We're not through that yet. We envision we will get through it within the next 6 months, and then we'd be in a position to sort of take that to a business case.
Okay. And last question from me at this point. You talked about, I think, 6 months ago about recontracting the swaption with Genesis or starting those discussions and being very keen not to use coal. We've just had 6 months where I guess the alternative thermal fuel gas has had a few scarcity issues. What's your thinking about the ability to actually achieve that goal now?
I think there's still, I think that's still our ultimate goal. We're working through a process with the market right now, looking at all the various options. And I wouldn't say there's any one solution either. There may be still some coal in the mix in the short term. I think gas has a bigger part to play. Demand management's also part of the overall picture. So we're looking at a range of potential options. I envision, and reality may play out in a different way, I envision we'll have a series of transactions as opposed to one large swaption as a replacement in 2023 when we get to that period, when we get to that time.
So quite a few moving parts in Australia. I just wondered if on the current kind of forward view of LGCs, what kind of guidance would you think we should think about, maybe not for the full year this year, although of course that would be helpful, but for the year ahead? What's sort of the contribution out of Australia you expect now with kind of substantial shifts in the price there?
I think it's plain to you.
Yeah, look, I think you can sort of work out from what we said already what that second half looks like. And I'm not going to be giving guidance about the following year, but there is no expectation that LGC price is going to pick up above that sort of $30 level, and that's where you've got to pitch your models, Neville. And there is the effect of the fact that we are hedged out across the following calendar year, which then settles the next year. So we have a 1 year's grace in there. But really, we've got to build the rest of our business around it in order to make those numbers up.
Second question, just following on the comment about the requirement as the ICCC's finding, the need for deep energy storage. If you move to a different contracting model around a swaption, do you think that is a replacement for the need for coal storage at Huntly? Or are you thinking that sort of is a substitute for Meridian's need?
I think it's probably more a substitute for Meridian's need at this stage. But I think you're going to see quite an evolution in storage capacity, capability and generation over the next 10 to 15 years as we seek to solve that particular problem.
And just a last question then, kind of first reaction to one of the EPR, of the many suggestions. One of them was that the EA should start looking on a periodic basis at the difference between contract prices and the cost of new supply. And you'd think on today's sort of metrics that would bring up quite a sharp contrast, given how cheap new supply is. Any thoughts about that?
I've had a look at that. You expect when you get supply-demand compression the price is going to lift above LRMC, otherwise nothing ever gets built. I mean, that's how the market is supposed to work. And there have been people looking at that differential for years, just they didn't happen to be inside the EA, so changing it to somebody else taking a view, it will still be a feature. People will still be looking at that. It's not new.
Thank you.
Anyone else here in Wellington? Okay, well, we'll hand it over to the phones.
If you wish to ask a question over the phones, please press 0 followed by 1 on your telephone keypad and wait for your name to be announced. Again, that is 01. Your first question comes from the line of Aaron Stott from UBS. Your line is now open. Please go ahead.
I think that was me, Aaron Ibbotson. Am I on the line?
Yes,
Aaron, it's you.
Can you guys hear me?
Yeah, we can hear you.
Okay, great. So 3 quick questions from me. So my first question relates to your comment around demand and long-term demand and wanting to keep your share. So I'm just curious to sort of see how you're envisaging this. Do you think it's going to be a modular approach where you add, say 30, 50 megawatt of wind per year and waiting for demand to come online? Or do you envisage any sort of material decision being taken, say, in 6 or 12 months' time? And maybe related, how long do you feel that you need to wait to know whether you think that demand is actually increasing, or do you feel like you're ready now? So I might just run through my 3 questions. My second question is on C&I prices. You mentioned that they've firmed a bit on new contracts. Having seen the operating stats from all of you guys, I guess I have been a little bit surprised how little they have firmed so far. And I just wanted to know if you were willing to share your thoughts on what you think is reasonable for sort of large corporate or C&I customers to pay, say, relative to long-run forward prices or wholesale prices or something. It seems to me that most of the gentailers considering paying spot for a variable volume contract is reasonable, which I guess has surprised me a little bit. And then finally, Neil, I know you've sort of mentioned a few times off the cuff maybe to some degree that, long term you're hoping that there might be a potential for a demand response contract or some deal with the TY smelter. Has that evolved at all, or is that still on the cards when it comes to your negotiations with Genesis on the new swap structure? Thank you.
Thanks, Aaron. I'll ask the first one. So, just to be clear, our objective on the new generation is to maintain the option to maintain our market share. We'll obviously maintain our market share if we think it's economically sensible to do so. But we want to make sure that we're in the game and we have options available to achieve that end outcome, assuming we're getting, the market's behaving in a rational way, which we fully expect it to. We have a philosophy that we'd like to see demand turning up before we build or contemporaneously as we build. We don't really want to build and expect it to turn up. So we'd like to see a condition where we think that the supply-demand balance has got to a point where new generation is needed before we actually launch into building that new generation. And I guess our strategy is very much focused around wind. I mean, we've got some hydro options and we're doing a bit in the solar space, which is interesting. But I think the mainstay of new generation New Zealand, outside of some geothermal stuff in the middle of the North Island, will be wind over the next 20-odd years. And I guess the way we're developing our options is in discrete chunks of new generation, which I think you can introduce into the market without upsetting wholesale prices too dramatically. So we think it's an incremental type of approach and one that doesn't destabilise the end outcome for wholesale customers. So that's sort of our approach or strategy around that. I think, Paul, you were going to talk to the CNI?
Yeah, look, the first thing to say is when there has been some margin compression in that segment, I think particularly as some of our competitors have come under pressure in terms of mass market volumes and have either re-entered or picked up volumes in the CNI space. So there has been margin compression, but I can definitively say we're not pricing at spot. We're pricing at that effectively that long-term ASX forward curve sort of level plus costs plus a margin. There's no way that we want to be doing that business without actually having some risk premium on our position. And we're still winning business. So that's the first thing to say. Second thing to say is I don't think you'd expect to see something that's happened relatively recently in terms of firming of that price curve make its way through to the net number, given that those books include contracts which are up to 3 years in length. Generally speaking, they're at least 2 years, and they're bid generally with about a 4 to 5 month lag. So people will be going into the market well before you'll be pricing a contract which was going live now would be priced by reference to where the ASX probably was 3 to 4 months ago. So I think you will see some lift, but it will be a proportionate lift that is around what rolls off with that lag. So I'm not surprised that you've seen that.
I can cover off the ends this one. I think, I mean, they are a large and important customer of Meridian's. They're a large, important part of the electricity sector in the New Zealand environment. We've always got a conversation going on with them to sort of see if we can't alter the existing contractual relationships in a way that that would provide benefit for both parties. But I'm not at liberty to sort of talk about any particular conversations in this sort of forum. Thanks, Aaron.
Okay, thank you. That was very clear. Thank you.
Your next question comes from the line of Grant Swanepoel from Craig's Investment Partners. Your line is now open. Please go ahead.
Good morning, team.
Hey,
Afternoon.
Hey, Grant.
Just a few questions following on from Aaron Ibbotson. Just in terms of the CNI market, are you seeing a lot of guys who were on spot now clamoring to cover that? You know, we've had a couple of results out already, and these companies are complaining about high energy costs and because they've been on spot. Also, are you guys taking advantage of Contact holding back in contracting because of their gas recontracting, and also probably Genesis is probably holding back as well because of their gas shortfall at the moment? So should we see some uplift from that front for you for the next quarter or so? Then in terms of your generation options, it looks like most of it's wind for the next many years. Is this not going to build up a need for the Genesis type swaption that is out there? And are you going to be putting pressure on to move them out of the market as opposed to trying to maybe keep them in the market on a 10-year view plus? And then the final question is just on OPEX. What should I consider as the non-normalized increase in OPEX for this half? Is it just a few million, or is it more elaborate than that? Thanks.
Talk to CNI.
I'll talk to the CNI and I'll do the cost thing and you can do the difficult one in the middle. CNI, so funnily enough, no, we haven't seen a big rush of people who are on spot through to fix their position. I think it takes a time to digest stuff like that. You know, it sits under the covers, some procurement guy who's made decisions, maybe hasn't taken full cover, and it takes its time to seep through into the mindsets of the CFO sort of faction, I think, having been a buyer on the other side. So it hasn't happened yet, but I would hope that we would only see people exposing themselves to that sort of risk who are big enough to take that sort of risk. The question around whether Genesis and Contact holding back is helping, look around the margins, but they're still in the market, and there are still other players in the market. So it might relieve a bit of that margin compression pressure, but it's still a pretty fiercely competitive market.
Yeah, Grant, to the development of wind or penetration of wind into the electricity sector, I mean, we did a study about 10 years ago that suggested that the sector can absorb a lot more wind on the back of very flexible hydro that we have in this country up to 20%. And I think we're at about the 5% mark. So we've got a long way to go before we start challenging the system from a firming perspective. So I don't see that entirely linked with the swaption replacement. I guess in that terms of that conversation, though, we're not trying to force anyone out of the market at all. We're engaging with all parties. What we're trying to do is ensure that we get a solution that's commercially sensible, viable for us, and reduces our exposure to thermal fuels.
And Grant, on
Can I just push?
Go ahead.
Yep.
Sorry, Paul.
Go ahead.
I sort of push on that comment. So you've got carbon potentially rising. The study done 10 years ago wasn't really talking about what could happen to capacity pricing. That's what I'm referring to. Since the 10-year-old study, we've got $25 carbon probably going to 75 over the next 10 or 15 years. We've got Genesis trying to run less gas. That's where my comment's going to. What's going to happen to capacity pricing down the line if we don't leave some of that capacity in the market? And then just to follow on that, you talk about wind options probably in the $60 to $70, probably the bottom end of that range, long-run marginal cost. Is that fully loaded cost in that if you didn't have hydro firming to back that up, would you not be adding $15 to that to be a comparable one to what the market should be trading at in terms of reference to what a new build would cost?
Can I do that bit, that last bit? We don't sort of think about it that way. Yeah, look, that's a fully loaded cost, but it doesn't take into account the sort of the nodal pricing impacts and the price capture factor of wind, and therefore, yeah, you do have to add some more on that. That doesn't describe what the long run cost curve looks like, because obviously nodal capture is at a lower rate, particularly in areas which are reasonably saturated with wind, like sort of Palmerston North and the area around there. So you do have to think about it slightly different.
Yeah, look, in respect to capacity, I mean, it's something that we look at and try and model reasonably effectively, Grant. I mean, if you think about it, the swaption is a form of capacity payment in today's market. The range of agreements that we think we're likely to line up with in 2023 will be possibly sort of 3 to 5 year type transactions. So we're not trying to solve the electricity system for the next 15, 20 years. We're trying to resolve our commercial position for the 5 years, say, beyond 2023.
And higher carbon prices are going to tend to drag in other solutions, Grant. There are other technologies that start to become possible once you get into that realm. And your cost question, yeah, just think simply. A few million, couple of years. Don't get complex on us.
Okay. Thanks.
Thanks, Grant.
There are no further questions at this time. I want to hand back to the speakers. Please continue.
Okay, well, thank you very much for attending. We're very proud of the result, and hopefully that's been helpful. Thank you very much. We'll call off there. Cheers.